The moment you reach 70 and a half, the IRS quietly activates 7 provisions that can rescue you thousands of dollars per year in taxes. Not next year, not when RMDs kick in, right now at 70 and a half, and the overwhelming majority of retirees will never utilize a single one of them because nobody clarifies that the rules shift at this precise age. Most people assume 70 and a half is irrelevant. They assume the significant ages are 59 and a half when the early withdrawal penalty vanishes, 62 when Social Security becomes accessible, 65 when Medicare begins, and 73 or when RMDs commence. Those ages receive all the focus. 70 and a half gets overlooked. And that is an oversight that costs retirees actual money every year they skip it. Today, I'm going to guide you through all 7 provisions. Each one lowers your taxes, shields your Social Security from being driven into the taxable zone, or guards you from Medicare surcharges. Some of them you can arrange in 15 minutes. One of them can rescue you more than every other tax approach in retirement combined, and the opportunity for utilizing some of them disappears the moment RMDs begin. Before I dive in, I need to be transparent. I'm not a lawyer, I'm not a CPA, I'm not a financial advisor. Nothing in this video is legal, tax, or investment advice. These are educational illustrations based on current tax law and publicly accessible IRS information. Always consult a qualified tax professional for your individual situation. If you are new here, this channel is for one particular audience: retirees and pre-retirees over 60 who want to grasp how the IRS actually functions in retirement. Not the version your brokerage includes in the newsletter, the real version with real numbers in plain English. If that describes you, subscribe right now because the video I'm releasing next week is going to demonstrate exactly what the IRS permits you to do at 59 and a half, and that one could alter your timeline. Drop a comment right now. Are you over 70 and a half? Just yes or no? I read every single comment, and the ratio between yes and no is going to dictate whether my follow-up video concentrates on how to utilize these provisions or how to get ready for them before you arrive there. 2 seconds, do it now. Let us dive in. Number 1, the qualified charitable distribution. This is the single most potent tax instrument available to any retiree over 70 and a half. And most people either do not realize it exists or do not comprehend how beneficial it is. Beginning at exactly 70 and a half, you can send money directly from your traditional IRA to a qualified 501c3 charity. That transfer is called a Qualified Charitable Distribution, or QCD. The cap for 2026 is $111,000 per person. If you are married and both over 70 and a half, you and your spouse can each do $111,000 from your own IRAs for a combined $222,000. Here is what makes the QCD so potent. The money travels directly from your IRA custodian to the charity. It never reaches your bank account. It never shows up on your tax return as income. It does not raise your adjusted gross income. It does not raise your provisional income. It does not force your Social Security into the taxable zone. It does not activate IRMAA Medicare surcharges. It is entirely invisible to every tax computation the IRS performs on your return. And once you hit the age when RMDs begin, the QCD counts toward fulfilling your required minimum distribution. So, instead of pulling $15,000 out of your IRA paying tax on it and then writing a check to charity from your bank account, you direct that $15,000 straight from the IRA to the charity. The RMD is fulfilled, the tax is zero. The charitable effect is the same. The only distinction is that the IRS receives nothing. Contrast the two methods. Without a QCD, you take a $15,000 RMD. It registers as income. It drives your provisional income higher. Up to 85% of your Social Security becomes taxable. At a 12% bracket, the tax on the RMD itself is roughly $1,800. Plus, the additional tax on the Social Security cascade is another $500 to $1,000. Total tax cost of donating $15,000 to charity the standard way, approximately $2,300 to $2,800. With a QCD, the total tax cost of donating the identical $15,000 to the identical charity, zero. You preserve $2,300 to $2,800 by altering how the money traveled from your IRA to the charity. Same donation, same charity, same amount, different path, thousands preserved. If you contribute to charity in any amount from $500 to your church to $50,000 to your alma mater, and you are over 70 and a half and you're not directing it through a QCD, you are giving the IRS money you do not need to give them. Contact your IRA custodian tomorrow. Fidelity, Schwab, Vanguard, they all make this simple. You complete a form, specify the charity, and they deliver the check directly. It takes 15 minutes to arrange, and it preserves you real money every year for the remainder of your life. Let me provide you a concrete illustration so you observe the full effect. A married couple, both 72, they donate $8,000 per year to their church and $2,000 to a local food bank. Total charitable contributions, $10,000 per year. They have been writing checks from their bank account for 20 years. Their income is Social Security of $38,000, IRA withdrawals of $25,000, and savings interest of $3,000. The provisional income is $25,000 plus $3,000 plus $19,000, which is half their Social Security. That equals $47,000. Above the $44,000 joint threshold, 85% of their Social Security is taxable. Approximately $21,840 of their Social Security is added to their taxable income. Now observe what happens when they direct the $10,000 in charitable contributions through QCDs instead of bank account checks. They withdraw $15,000 from the IRA for living expenses instead of $25,000, and the other $10,000 travels directly from the IRA to the church and the food bank as QCDs. Their adjusted gross income falls by $10,000. Their provisional income falls from $47,000 to $37,000. They shift from the 85% zone into the 50% zone. The taxable portion of their Social Security falls from $21,840 to approximately $5,000. Their federal tax falls by approximately $2,000. They contributed the same $10,000 to the same charities. Their lifestyle did not shift. They just altered the path the money followed, and that path alteration preserved them $2,000 per year. Over 10 years, that is $20,000 on a $10,000 annual contribution. There are 3 typical errors people make with QCDs. First, they have the IRA custodian deliver the money to them and then they write the check to charity. That does not qualify. The money must travel directly from the custodian to the charity. You never handle it. Second, they attempt to use a QCD with a donor-advised fund. Donor-advised funds do not qualify for QCDs. The money must travel to an operating 501(c)(3) charity. Third, they execute the QCD one day before they reach 70 and a half. The IRS is rigid. You must be 70 and a half on the day the distribution is processed. Not 69 and 11 months, not 70 and 5 months, 70 and a half. Verify your exact date before your first QCD. Did you understand QCDs before this video? Drop yes or no in the comments. I'm sincerely curious because this is the provision that preserves more money than any other for retirees who contribute to charity, and most people have never encountered the term. Number 2, the one-time QCD to a Charitable Remainder Trust or Charitable Gift Annuity. This one is recent. The Secure 2.0 Act established a provision that permits you to make a one-time QCD of up to $55,000 from your IRA to fund either a charitable remainder unit trust, a charitable remainder annuity trust, or charitable gift annuity. This is a lifetime cap, meaning you can only execute it once. Here is why this is significant. A charitable gift annuity or a charitable remainder trust distributes you income for the remainder of your life, and then the remaining assets transfer to the charity when you pass. Normally, funding one of these with IRA money would require you to withdraw the funds, pay income tax on the withdrawal, and then contribute the after-tax amount. With this provision, you fund it directly from the IRA through a QCD, no income tax on the transfer. The charity gets funded. You receive a lifetime income stream. The IRS receives nothing on the initial transfer. On $55,000, the tax savings on the transfer alone at a 22% rate is $12,100. Plus, you avoid the Social Security cascade and IRMAA exposure that the withdrawal would have produced. The total tax advantage can exceed $15,000 on this transaction. This is not for everybody. It requires collaborating with a charity that provides gift annuities and comprehending the payout rates and terms. But for retirees who are already charitably minded and have large traditional IRAs, it is one of the most tax-efficient methods to generate guaranteed income while supporting a cause you believe in. Number 3, the pre-RMD IRA reduction window. This is the provision that most retirees entirely overlook because they do not comprehend the calendar. QCDs begin at 70 and a half. RMDs do not begin until 73 if you were born before 1960 or 75 if you were born in 1960 or later. The interval between 70 and a half and the onset of RMDs is a window of 2.5 to 4.5 years, where you can employ QCDs to decrease your IRA balance before the IRS begins compelling money out. Why does this matter? Because RMDs are computed based on your IRA balance as of December 31st of the preceding year. The greater that balance, the greater the compelled withdrawal. The greater the withdrawal, the more Social Security gets taxed, the more probable you are to activate IRMAA, and the greater your effective tax rate. If you employ QCDs during the pre-RMD window to decrease your IRA balance by $50,000 to $100,000, your future RMDs contract proportionally. On a decrease of $100,000, your first RMD falls by approximately $4,000 per year. That $4,000 less in compelled income maintains your provisional income lower, maintains your Social Security in a lower taxation zone, and potentially maintains you below the IRMAA threshold. The pre-RMD window is limited. Once RMDs begin, you can still execute QCDs, but the initial dollars out of your IRA must fulfill the RMD before any additional QCD counts. The tactical advantage of decreasing the balance before the clock begins running is enormous, and most people do not even realize the window exists. Let me demonstrate the math on this. A retiree reaches 70 and one-half in 2026 with a traditional IRA of $500,000. RMDs will begin at 75 because she was born in 1960 or later. She has 4.5 years in the pre-RMD window. If she executes QCDs of $15,000 per year for 4 years, she decreases the IRA by $60,000. At 75, her balance is approximately $510,000 with growth instead of $570,000. Her first RMD falls from approximately $23,170 to approximately $20,732. That is approximately $2,438 less in compelled taxable income every year for the remainder of her life. At the 12% bracket, that preserves her approximately $293 per year in direct tax on the RMD. But the cascade effect on Social Security taxation preserves her an additional $400 to $600 per year. Combined annual savings approximately $700 to $900. Over 20 years, that is $14,000 to $18,000 preserved, all because she utilized the pre-RMD window to decrease her balance by $60,000 through QCDs that she was going to execute anyway. Number 4, the final Roth conversion window before RMDs complicate everything. If you are 70 and one-half, you have between 2 and one-half and 4 and one-half years before RMDs commence, depending on your birth year. This is the closing stretch of the gap years, and every year of conversion capacity that remains is valuable. Once RMDs begin, Roth conversions do not cease being possible, but they become significantly harder to accomplish efficiently. Your RMD must be withdrawn first before any conversion. That RMD occupies the lower tax brackets. The conversion then layers on top, often landing in the 22% bracket or above. At 70 and one-half, if your income is managed, you may still have space in the 12% bracket to convert $30,000 to $50,000 per year. At 73 or 75, when the RMD occupies $15,000 to $25,000 of that bracket capacity, your conversion space at 12% contracts dramatically. The math is direct. Every dollar you convert at 12% now preserves you 10 to 18 percentage points on that dollar later, when it would have emerged as an RMD at 22 to 30% effective rate, including the Social Security cascade. On a $50,000 conversion, that is $5,000 to $9,000 in lifetime tax savings per year of conversion. If you are 70 and one-half and you have not initiated Roth conversions, you're in the final window where the math operates in your favor. After RMDs commence, the window does not shut completely, but the advantage diminishes every year. Let me illustrate why the math shifts so dramatically once RMDs begin. At 70 and one-half with no RMDs yet, a single filer with Social Security of $30,000 and $2,000 in savings interest has a taxable income, after the standard deduction of $18,150 of approximately $13,850. She is in the 12% bracket with over $36,000 of space before reaching 22%. She can convert $36,000 at 12%. Total conversion tax approximately $4,320. Now advanced to 75 when her RMD begins. Same Social Security, same savings interest, but now her RMD of $18,000 is compelled into the brackets first. After the standard deduction, her taxable income before any conversion is approximately $31,850. She has only $18,550 of 12% capacity remaining. Her conversion potential at the lowest rate just shrank by half, and it deteriorates every year. At 80, the RMD percentage is greater. At 85, greater still. By 85, the RMD alone may occupy most of the 12% bracket, leaving virtually no space for conversions at favorable rates. There is also the IRMAA consideration. Every dollar of Roth conversion counts toward your modified adjusted gross income. At 70 and one-half, if your MAGI is below $109,000 as a single filer, you can convert up to that threshold without activating Medicare surcharges. But remember the 2-year look-back. A conversion you execute at 70 and one-half in 2026 impacts your Medicare premiums at 72 and one-half in 2028. Structure the conversion amount with one eye on the tax bracket and the other eye on the IRMAA tier. The conversion still almost always makes sense, but you need to understand the complete cost. Number 5. The new code Y on your 1099-R. This one is not a tactic. It is a reporting modification that resolves a problem retirees have been confronting for years, and virtually nobody is aware of it. Beginning with the 2025 tax year, the IRS introduced Code Y for Box 7 of Form 1099-R. This code specifically designates a distribution as a qualified charitable distribution. Before this code existed, QCDs were documented as regular distributions on your 1099-R. Your tax software interpreted them as taxable income. You had to manually exclude them on your return, and if your software or your preparer did not manage it correctly, you paid tax on money that should have been tax-free. This occurred constantly. Retirees would execute a QCD, assume they were finished, and then realize in April that their tax software counted the distribution as income. They overpaid. Some of them never detected it. Code Y resolves that problem. When your IRA custodian issues the 1099-R with Code Y in Box 7, your tax software recognizes automatically that this distribution was a QCD and omits it from income. No manual modification, no potential for error. If you executed a QCD in 2025 or earlier and your preparer counted it as taxable income, you may have overpaid. You can submit an amended return within 3 years to correct it. Review your 1099-R from 2025. If the QCD is noted with Code Y and it was counted in your taxable income on your return, that is money the IRS owes you back. If you have stayed with me this far in the video, you're precisely the type of person this channel is designed for. Press the like button right now. It takes 1 second and it signals YouTube to present this to more retirees who need to learn this. And if you are not subscribed, handle it now. I review your comments every day. The most frequent one is, how do I determine what this means for my circumstances? That is why I assembled a guide that instructs you how to use AI tools to resolve any retirement tax question with your own figures in minutes. If these videos are beneficial to you, that guide is the next step. Link in the description. Number 6, Social Security Maximum Benefit plus Provisional Income Management. If you postpone Social Security until 70, your benefit is now at its peak. For every year you postpone past your full retirement age, the benefit increased by approximately 8%. At 70, your benefit is 132% of your full retirement age amount. That is secured permanently with cost of living adjustments on top. At 70 and 1/2, you have been receiving that maximum benefit for 6 months. And now the question transitions from when should I claim to how do I defend what I am receiving from being taxed? The answer is provisional income management, and 70 and 1/2 is the age where this becomes the most consequential calculation in your financial life. Your provisional income is your adjusted gross income plus any tax-exempt interest plus half your Social Security. If you are a single filer and your provisional income surpasses $34,000, up to 85% of your Social Security is taxable. For a married couple filing jointly, the threshold is $44,000. At 70 and 1/2 with a maximum Social Security benefit of approximately $40,000 per year, half of that is $20,000. That $20,000 enters your provisional income before you have pulled a single dollar from any other account. You only have $14,000 of breathing room before you cross the $34,000 threshold as a single filer. T.